In honor of Tesla that IPO'd 14 years ago today, here is this archive clip from Elon Musk doing an interview on Bloomberg. And I think there is a compelling case to what was said then and what's going on now with Tesla.
Next moves after an IPO that raised $226 million, about a quarter more than expected. I want to bring in the man who staked his personal fortune on that IPO. He's the PayPal co-founder, Elon Musk. And Elon, great to have you with us. We've been looking forward to talking with you. And, with all these reports about your IPO and the company, a lot of it focuses on the loss-making part of Tesla. Hasn't made any money. The prototype, you don't know yet whether or not you're going to be able to mass produce a company on the Model S. There's no distribution system yet. It almost seems as if investors are buying into your company on a leap of faith.
Well, first of all, I should mention that not only were we able to increase the size of the offering and price above the range, but the quality of investor that people will see, when people see who's investing in IPO, it's the smartest, most long-term thinking investors in the market. It's really an amazing set of investors. So I think it's just worth noting that the smartest money in the world is betting on Tesla. They must have a reason for doing so, because obviously to go public,
right,
and increase the range and increase the price in this market is not easy.
And yet, but
and
you've
these are
got
very well-informed people.
Right, but you've got an equal number of people who are saying, there has to be more, answered. There has to be more questions that have to be answered. Essentially, what are you going to do with this money, and how are you going to stop losing money in Tesla?
Yeah. Well, I think an important point that seems to be lost by most people is that if Tesla were just making the sports car and doing our powertrain supply business, we would be profitable as a company. However, we're expanding massively. We're talking about expanding by 3,000% in the space of 2 to 3 years. It's just not possible for the company as a whole to be profitable with that kind of with that rate of expansion, and that's the reason for the unprofitability. It's not some fundamental flaw in the Tesla business.
Right. We had a guest earlier on Elon who said, look, he wouldn't buy a company, a Model S, unless it was part of a larger firm, a larger auto company. Is the end game for Tesla to be acquired by a larger car company?
No, I think our goal is to remain independent and to create the most compelling and competitive car company of the 21st century. That's what we intend to do. Yeah, I mean that's the strategy we're executing against.
Okay, so an acquisition is out of the question.
I wouldn't say the question. It's just not something we're aiming for.
Okay.
I don't think it's sort of like aiming for happiness. You don't aim for happiness. You do things that result in happiness.
And it might appear, right? Okay, Elon, before I leave you, though, I've got to ask you about your divorce proceedings because they are part of your prospectus. You've tried to reassure investors that your divorce settlement is not going to impact your holdings in Tesla. How can you guarantee that?
Well, it's a longer explanation than can be given in a short interview. But suffice to say that the Department of Energy, the underwriters council, other investors have done their due diligence, and to the best of their assessment, they don't think it will affect
your stake is not going under 65% in Tesla, is what you're saying. You're guaranteeing that.
Yeah, to be precise, that no more than 35% of my ownership of Tesla would be sold. That is correct. There is no way that could occur.
Okay, Elon, we're going to have to leave it there, but I appreciate you joining us and taking some of these questions. Tesla CEO Elon Musk talking about the IPO.
Yeah, it's safe to say you should never bet against Elon. But yet, $21 billion is still betting against Elon and Tesla that's the amount of money that is currently sold short in Tesla stock. I do think, as you've seen in the last video, hopefully you watched that with what Dan Ives says, that the second half of this year could be very explosive for Tesla, especially 2025 as rates start to get cut, as we have a little bit more clarity what's going on in the economy. That's when I would expect Tesla stock can actually hit a new all-time high. But indeed, between now and then, there are some risks out there. And I mean, wow, take a look at this. We have a new low price target for the S&P 500 that was put on Friday. Apparently, stocks will fall 30% as the U.S. economy heads for a painful recession. This is from BCA Research, Peter Burson. And this is a new Wall Street low price target. He gave his year-end price target for the S&P 500 at 3,750. That would be 375 for the SPY. That is lower than JP Morgan's global research year-end target of 4,200. The previous Wall Street low. They say due to expectations that the U.S. will enter a sudden and unexpected recession. Burson expects that recession to begin either later this year or in 2025. Potentially making matters worse for markets, Burson expects the economic pain will be widespread. He expects growth in Europe, which is only just starting to pick up to slow, and China, which is still struggling in the aftermath of the collapse of the real estate bubble, could also succumb. The upshot in this scenario, global growth would weaken at large, weighing on global stocks. As far as the U.S. is concerned, Burson's thesis is rooted in the notion that a slowdown in the labor market is poised to accelerate rapidly, keeping enormous pressure on consumer spending, a key economic driver. He rattled off a number of indicators suggesting that the torrid pace of pandemic-era hiring has given way to something far less appealing to workers. As official job openings data show, the number of open positions have fallen substantially, as has the quit rate, and the private survey of job openings reflects an even more dramatic decline. Peter Burson took to X recently. He said, I hope this is a data error, but LinkedUp's estimate of job openings posted by America's top 10,000 companies is crashing, and it's literally going straight down. To make matters worse, it was recently reported that all of Americans' excess savings are gone, reaching as high as $2.1 trillion in 2021, and now you're actually negative $169.6 billion. So people are actually net in debt. They don't have savings. And if you were to theoretically see people start losing their jobs, there would be no cushion to fall back on. And that would be insanely problematic. Now, why I'm really sharing this with you is because I personally find a lot of value in contrarian opinions. It is easy to be bullish on markets right now. It's easy to chase the markets and keep raising price targets. But I really like to pay a lot more focus to the individuals that are making contrarian calls. For an example, right now it's JP Morgan and it's Peter Burson that now have the lowest price targets on the S&P 500, coming out with new thesis on why that is going to happen. I like to pay a lot more attention to that than people that just continue to be on the same bandwagon that has already been working. Now, who knows what's ultimately going to, turn out to be correct? But even to the flip side of this, in 2022, Tom Lee specifically was very bullish on markets. Not a lot of people were bullish on markets in 2022. If you listen to that contrarian opinion, he was correct. It took some time, yes, and he was not correct right away, but he was ultimately correct. And specifically, where to put your money, he was correct on that as well. So I find a lot of value in the contrarian opinion to popular belief. Peter goes on to say, there have also been signs that consumer spending has been slowing in recently released economic data, including Friday's personal consumption expenditures price index for May. But Burson believes this could only be the beginning, as a suddenly enfeebled labor market may kick off a vicious cycle. Data on bank balances already show that the lower income Americans appear to have depleted their pandemic-era savings, as delinquency rates for credit cards and auto loans, already at levels unseen since 2010, continue to climb. Banks could opt to raise their lending standards, adding to pressures facing the consumer. As the consumer slows, Burson expects businesses could slow their spending on capital projects. Indeed, data collected by BCA that tracks businesses' spending plans show that many are already preparing to cut back on capital expenditures, or CapEx, despite the artificial intelligence boom, the CHIPS Act, and the ongoing reshoring trends that Wall Street believes should boost this type of spending. Once the recession envisioned by Burson arrives, the Federal Reserve likely won't swoop in to stop it, at least not right away. Fear of reigniting a second wave of inflation likely means Fed Chair Jerome Powell and his colleagues would be reluctant to act until it's already too late. And fiscal policy likely won't be much help either. The budget deficit is already projected to grow 7% of GDP in 2024, according to official Congressional Budget Office estimates. So basically, we don't have a capacity to just, give out more money if we do go into a slowdown or a recession. As a result, regardless of who wins in November, the bond market would likely rebel against any attempts to increase unfunded spending. So again, that would not be good for the bond market if the government wanted to try to bail everything out again. So you're in a pretty precarious, sticky situation, and that would not be great. BCA recommended that clients reduce their equity holdings while boosting their allocations to bonds and cash earlier this week. Berskin recommended a few, including shorting the price of Bitcoin and betting that falling bond yields will drag the US dollar lower against the Japanese yen. Burson expects the yield on the 10-year Treasury note could fall to 3% if his recession scenario pans out, while the Fed funds target rate could be cut to 2%. By comparison, the 10-year Treasury was at 4.34% on Friday, while the Fed funds rate remains in the range of 5.25 to 5.5%. For its part, JP Morgan's top strategist Marko Kolanovic reaffirmed his target for the S&P 500, which is calling for the index to drop more than 23% from current levels by year end. According to JP Morgan's mid-year outlook released this week, the investment bank expects U.S. growth to moderate during the second half of 2024. The investment bank's bear case for stocks is based on the notion that the mega cap names that have driven much of the market's rally over the past year will face an increasingly high bar to impress investors with their earnings and their forecasts. Investor positioning evaluations for these names already look stretched, according to Kolanovic. This means that at some point the artificial intelligence trade that has been holding up the market should reverse, and when that happens, the S&P 500 should see a major pullback. Let me know what you think about that down below in the comment section. Goldman Sachs hedge fund chief Tony Pasquariello says it's time to cut portfolio risk. He says, quote, "It's a bull market, but the probability of a drawdown is rising." He says, "The history book tells us the risk of a sell-off increases as the rally narrows," he warned. To be sure, it's really just that instinct, that gut feel, perhaps some pattern recognition, which renders a general sense for short-term risk/reward. So he's basically saying, like, hey, in the S&P 500, what's the real risk here? Is the risk that you lose out on 10% more gains in the S&P? Is that the logical risk? Or is the risk that the S&P 500 could fall 10%? Like, statistically speaking, I'm not as, math expert, but I would argue there's less than a 10% chance markets go up 10% from here, and there's probably a 90% plus chance that the markets fall 10% from here. After all, during an election year, the average drawdown is 13%. You've seen a 5% drawdown in the spring. It's pretty abnormal to see the markets just going straight up like you have in 2024 during an election year. Normally, you do see more volatility. Normally, you do see more pullbacks, and you haven't seen that yet. So that begs the question, could you start to see more of a drawdown over the next couple of weeks and the next couple of months? After all, hedge funds are dumping technology stocks at the fastest pace since at least 2016. And again, what you've seen on Friday was the market on close imbalance towards the S&P 500 at negative 2.7 billion, the Nasdaq 100 negative 2.1 billion, the Dow 30 negative 550 million, and the Magnificent 7 specifically negative 1.2 billion. Now, again, as I already talked about in other videos, you've seen Apple, Nvidia, Google, Amazon, all of your big tech really selling off towards the last 30 minutes of the close on Friday, and that was because it's the last day of Q2. You're officially starting the second half of this year here on Monday, and you're already there right now. That's when you lock in profits if you are a hedge fund institution, and that's where you redeploy capital in our markets. Now, again, as I mentioned in the last video, Tesla stock was actually green in the last 30 minutes of trading. Tesla stock actually got some buy orders coming in. Look at this candle, the last minute of the trading day on Friday. You had 6.2 million for volume, and that was almost up 0.1%. Overall, the last 30 minutes or so of trading, Tesla stock went up $30. That's a good sign that Q3 can be a strong one for Tesla stock's performance. I think the real question here is not, do we go into a correction? Do we go into a crash? I think bare minimum, we have to be prepared for a correction. Probably could come with this earnings season, if not some of the upcoming economic data, like your non-farm payrolls report. Let me just be honest with you. If you get a sub 60,000 non-farm payrolls number or a negative number, that could set you up for a 10 to 15% pullback alone, let alone, everything else going on, let alone if earnings, disappoint or don't impress investors. There's a lot of risk in the economic data in the Fed with earnings because expectations are so high. This would be a much different story if stocks were trading at lower levels. Now, I do think areas like Tesla and small caps are better priced for a not so rosy or optimistic, second half of this year. You're still down 50% on Tesla from all-time highs. I think you're way better priced than your other big tech stocks. And I do think a 10% correction is inevitable. Now, a 30% crash or so could come based on more recession fears or an actual recession starting to materialize, in which we're already headed in that direction. If you look at initial jobless claims, look at Michigan, current economic conditions, look at sentiment surveys out there. People are not doing good. People are not feeling good. This economy is not as strong as you think it is. Just go talk to people. Ask them how they feel the economy is. And they're going to tell you not great. And that just flies in stark contrast to what's happening in markets, what's happening with the economic data. Now, the problem is the data moves with such a lag. The data that we just got, last week, especially for spending, income, PCE, was all for the month of May. I think the June data is going to come in a lot worse than we think. And that is a potential risk to markets we need to be open for. And I do personally agree, whether we see a 10% correction or a 30% crash, we want to be prepared with cash on the sidelines, ready to take advantage of any downside that we see in markets, because I do believe we'll probably go into a recession. We'll probably see a 30+% crash at some point this year or next year, but that's going to set you up for a multi-year, if not decade-long bull market that has everything participating. As rates are low, inflation is crushed, you will really see a broad-based bull market for many years, if not a decade or two. And I think you also want to be prepared for that as well. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. Most importantly, enjoy the rest of your day, and I will see you in the next one.